Good day to you all. Welcome to the fourth lecture of Shipmaster Business and Law lecture series. Today we'll discuss about insurance. Let's begin. Let us see what is insurance. Insurance is a financial arrangement designed to protect individual, businesses or other entities against the risks of loss, damage or liability. In essence, it's a way to transfer the financial burden of an uncertain event from yourself to an insurance company. Like you have got a car accident, so if you have got insurance, the insurance company will help you to recover the damage done during the accident. In that way, insurance works. Let us see what are the key elements of insurance. In the insurance, we have got 5 key elements. First one is policyholder. So for the insurance, someone has to a insurance for his property. So that person is called the policyholder. Then we have got the insurer who insures that he will take responsibility if there is any accident or damage done to that property. Then the premium in the premium section, it is decided how much money the policyholder will give per month or per year for the insurance. Then the policy, in the policy it is written in detail how the insurance will work. Then the claim, so in the claim section it is written how to get the compensation if there is any damage done, right? So they are the 5 elements of insurance. How insurance work? The insurance work basically by risk pooling, right? So how it is been done? Many policyholder pay premiums into a common pool. Not everyone will suffer a loss at the same time. So the pooled funds are used to pay those who do, right? So in that way, by risk pooling, insurance work. So in the insurance industry, underwriter plays a big role. So this insurer evaluates the risk of insuring a particular person or property and set the premium accordingly. So those people are called the underwriter. Indemnification. When a covered loss occur, the insurer compensates the policyholder up to the policy limit minus any deductible, restoring them to the state they were in before the loss. So the insurance company take the responsibility to restore your property to the previous condition before the accident happened. Why insurance matter? The first thing is that it will give you a financial security. So you know that if something goes wrong, the insurance company is there who will help you to restore your property to the original condition. It gives you peace of mind. Most of the case in the maritime industry is regularly recommended to have insurance of the cargo or ship, right? And it is a method of risk management. What is marine insurance? Marine insurance is a contract whereby the insurer agrees to indemnify the insured against marine losses or damages to ship, cargo, terminals, and any transport or cargo by which property is transferred, acquired, or held between points of origin and final destination. This is the definition is given by the Marine Insurance Act. So as per Marine Insurance Act, the marine insurance is a contract whereby the insurer agrees to indemnify the insured against marine losses. It is a process of transferring or sharing the risk in maritime trade, right? So it is very commonly used in the maritime industry. Let us see what are the regulations related to the marine insurance. The first regulation was introduced in UK. It is called Marine Insurance Act. In short, we call it MIA 1906, right? The Marine Insurance Act 1906 is the UK statute which codified the law relating to the marine insurance. It brought together long established common law principles into a single statute and remains the foundation of marine insurance law in the UK and many other jurisdictions, right? So most of the Commonwealth nation actually they follow the Marine Insurance Act. Carriage of Goods by Sea Act 1971, there is another cornerstone of marine insurance. The Carriage of Goods by Sea Act 1978 is the key UK statute that governs the right, duties, defences and liability limits of carriers under contracts for the carriage of goods by sea. Here which one is the carrier? Carrier is the ship. To understand insurance, we need to understand the principle of marine insurance. As per Marine Insurance Act 1906, the principle of marine insurance are the foundational doctrines that govern the relationship between the insured and the insurer. This principle ensure fairness, transparency, and legal enforceability in the marine insurance contract. Let us see what are the principles of Marine Insurance Act. The first principle of Marine Insurance Act is utmost good faith. Then the second one is insurable interest. The third one is indemnity. The fourth one is contribution. The fifth one is subrogation clause. Sixth one is proximate clause. The seventh one is loss minimization, and the eighth and last one is warranties. So they are the 8 principles of marine insurance as per the MIA 1906. Let us see what is utmost good faith mean. So as per utmost good faith, both party must disclose all material facts truthfully and completely to each other. A material fact is one that would influence the insurer's decision to accept the risk of the risks or set the premium. A non-disclosure or misinterpretation can lead to contract being declared void. So, for example, the ship owner must disclose prior damages or repairs to the vessel. Right? Once the ship owner disclose that thing, then the insurer will set a nice premium for the ship owner. Right? Insurable interest. What is that? As per MIA, the insurer must have a legal or financial interest in the subject matter of the insurance at the time of the loss, right? So if you don't have any interest on that property, actually you cannot do the insurance. The insured should stand to suffer a real loss if the insured event occurs. It is the legal relationship to the subject matter insured. For example, a cargo owner has an insurable interest in the cargo they are shipping. Indemnity. This is the third principle of marine insurance. What is that? As per MIA, the insured is compensated only to the extent of the actual loss, not more. That means from insurance you cannot make profit. The purpose is to restore the insured to the original financial position, not to allow profit from the insurance, right? So if the cargo loss is valued $10,000, the insured cannot claim $15,000 for the loss. So he can claim only up to $10,000. Contribution. As per MIA, if the same risk is insured with multiple insurer, the claim arises, each insurer contributes proportionately to the loss, right? So it prevents the insured from claiming the full amount from each insurer. So for a same property or for a same cargo, you cannot claim double compensation from different insurance company, right? So suppose if you have a cargo and if the cargo is insured for $100,000 with two insurer at 60% and 40%, then if something goes wrong with that cargo, then they will share any claim accordingly. Subrogation. There is an interesting clause. Let us see what is that. As per Marine Insurance Act, once the insurer pays for a loss, they gain the right to step into the shoes of the insured and recover the amount from any third party responsible. For example, if a container is damaged due to port authority negligence, the insurer can sue the authority after compensating the cargo owner, right? Proximate clause. The insurer is liable only for losses proximately caused by peril covered under the policy. It refers to the dominant and effective and nearest cause of the loss, not merely the last in the chain of the events. For example, if a cargo damage is due to seawater entering through a storm damaged hatch, the storm is the proximate clause for the damage. Loss minimization. As per MIA, the insured must take reasonable steps to minimize or prevent further loss once peril occurs. Right? This is a duty even if the loss is fully covered by the insurance. For example, if a fire breaks out in a cargo hold, the ship's crew must attempt to extinguish it to limit the damage. Right? Though the ship is insured, the ship's crew must take all the reasonable steps to extinguish the fire. Warranties. So these are the conditions or promises in the insurance contract that must be strictly complied with. Breaches of warranty, whether material or not, can discharge the insurer from liability from the date of breach. For example, if a policy may contain a warranty that the ship will sail on a particular date, failure to do so can void the policy. Right? So these are the warranties are the must do promises or must do conditions where the ship has to follow. Right? If the ship or the carrier cannot follow that one, then the insurance policy may void. So I want you to in your notebook draw this table where I try to describe all the 8 principles in single line. So what is utmost good faith? Utmost good faith means full disclosure of all material facts. Insurable interest means financial interest in the insured subject. What is indemnity? As per indemnity, no profit from the loss, right? So the insurance cannot insure the insured cannot make profit out of the uh, loss. Contribution, loss shared among insurer if multiple policy exist. Subrogation, insurer recovers from third party after compensation. Proximate clause, claim paid only if peril is dominant clause. Loss minimization, insured must try to reduce loss after an incident. And warranties, conditions in the policy must be strictly followed. So they are the 8 key principles of insurance. So in the maritime industry, we have got basic 2 type of policies. The first one is uh, based on time. So most of the time, the time charterer, they use this type of policies. So this is called the time policies. So these time policies can extend up to 12 months. Sometimes it goes for maybe 6 months, 4 months. So for a specific time, the ship or carrier buys this type of policy. Sometimes the shipping company, they buy the insurance for a specific voyage. Suppose you start a voyage from Tanjung Pelapas, Malaysia to Southampton Port in UK. So you just bought the insurance only for that voyage, right? So this type of policies also been bought in the maritime industry. Let us see the types of maritime insurance. In the maritime insurance, there is basically these 2 type of insurance. The first one is hull and machinery insurance, and the second one is P&I insurance. We call it protective and indemnity insurance. We'll discuss these 2 type of insurance in the following lecture. So what is hull and machinery insurance? The hull and machinery insurance is a type of marine insurance that provide compensation for partial or total loss or damages to a ship or vessel, including its engines, equipment, and machinery due to maritime peril. Claim example: a vessel collides with a submerged object, causing damage to its propeller and hull plating. Estimated repair cost is $500,000. Policy has $50,000 deductible. Insurer pays $450,000. In that way, this hull and machinery insurance work. And owner pays $50,000 only, because policy has a $50,000 deductible from the owner. Let us see which of the thing is covered by the hull and machinery insurance. Is hull is covered, damage to hull due to collision, grounding, storm, or fire. This hull is fully covered by hull and machinery insurance. Then all the machineries in the ships, especially engine damage, generator failure, boiler explosion, all are covered by the hull and machinery insurance. Then other equipment like anchor, steering gear, propeller, shaft, navigation equipment are covered on the hull and machinery insurance. The third party property damage due to contract is also covered by the hull and machinery insurance. What is that? Sometimes what you do, maybe once you are approaching to port, maybe you have damage the port jetty, right? That is also covered by the hull and machinery insurance. Salvage and sue and labor, cost of saving the vessel or minimizing loss after the incident is covered by the hull and machinery insurance sometime. What is not covered by the hull and machinery insurance? Let us see. War and terrorism. So unless you have added a war risk clause, the ship which goes to the war risk zone, it is not covered by the hull and machinery insurance. Deliberate misconduct or negligence of the owner, right? So if the damage is been done by the deliberate misconduct of the ship's crew, then it will not be covered. Wear and tear of the gradual deterioration of the any equipment, right? So suppose you have got an anchor in the anchor windlass you have some wear and tear, and for that, that's why that anchor windlass has damage. That will not be covered by the hull and machinery insurance. Nuclear risk and crew liability, right? This crew liability, like the crew death of crew, or any damage done to the crew's the crew injury, it is not covered by the hull and machinery insurance. Let us see what is P&A insurance. P&A insurance is a type of marine insurance that protects ship owners, operators, or charterers against legal liabilities they may incur towards third parties during ship operation. It is typically provided by the P&A clubs. These P&A clubs are the mutual association owned by their member. These members are basically the ship owners. A real life example. Let us see a ship accidentally discharged while into a port due to a valve malfunction. The port authority demands cleanup cost of $1.2 million, fines of $200,000, third party environmental claim $800,000. So the total cost due to that pollution is $2.2 million. This whole $2.2 million will be covered by the P&A insurance. Let us see what are the things is covered by the P&A insurance. Injury and death, right? So the crew injury, death, passenger claims, everything is covered by the P&A insurance. Cargo liabilities, damage to cargo, short delivery, late delivery claims, oil spill, chemical pollution, all is covered with the P&A insurance. Fines and penalties for immigration breaches, custom issues, MARPOL violations. So these are the, if the ships get some penalties for that, it is covered by the P&A insurance. Cost related to repatriation, detention, or care of stowaways. So these are the refugee cost or stowaways cost is related to stowaways. Cost related to the stowaways or refugees is covered by the P&A insurance. Quarantine expenses, costs incurred during port quarantine or co-illness outbreak. Legal liability during towage and salvage operation is covered by the P&A insurance. Let us see what is not covered by the P&A insurance. Hull and machinery damage, that will not be covered by the P&A insurance. Loss or damage to own ship or equipment, that will not be covered by the P&A insurance. Deliberate or unlawful acts by the ship owner will not be covered by the P&A insurance. Trading in sanctioned countries, right? Suppose you are trading in Russia, right? That if something goes wrong and you have done some pollution over there, then it will not be covered by the P&A insurance. War and terrorism, right? So now the war is going on between USA and Iran, right? And due to that war, if something goes, some accident happens, or any pollution incident happen, then or any crew injury happens, that will not be covered by the P&A insurance. For you, I have created a mind map here. At the top, I have given the key elements of marine insurance. Then I have given the regulations which is related to the marine insurance. At the bottom, I have given the types of marine insurance, which is divided in the P&A insurance and hull and machinery insurance. And at the left side, I have given you the 8 principles of marine insurance. I think that mind map will help you to understand the insurance better. Let me know if you've got any question about insurance. We can discuss more on that. See you in the next lecture. Thank you very much.